currency analysis a little bit later in the program. So it's all about the U.S. Fed for now, and it was really interesting to note that we are now expecting to see only perhaps one interest rate hike between now and the end of 2016. And again, while the U.S. Fed did mention Brexit in its decision to hold off on hiking rates this time around, so much of what the Fed is talking about is really focused on that old, term that we use a lot, data dependency. Let's take a listen to what Janet Yellen had to say.
Proceeding cautiously in raising interest rate target will allow us to verify that economic growth will return to a moderate pace, that the labor market will strengthen further, and that inflation will continue to make progress toward our 2% objective. Caution is all the more appropriate given that short-term interest rates are still near zero, which means that monetary policy can more effectively respond to surprisingly strong inflation pressures in the future than to a weakening labor market and falling inflation.
Let's bring in Mark Bayley from FIIG Securities to find out what he makes of it all. Good morning to you, Mark. Good to see you.
Yeah, good morning, Nadine. Good to be back.
JP Morgan says that 6 FOMC participants are now only expecting one hike in 2016, and it suspects that Yellen is amongst those. And JP Morgan says generally it's not wise to the Fed chair. Would you agree?
I agree, yeah. I mean, there's been a huge change in terms of those blue dot plots that everybody has been looking at. And as you rightly say, 6 of those FOMC members are now expecting just one hike during 2016. Even though the median is still at 2 hikes, a lot of those have probably moved from 3 or 4 hikes that were expected back in March. So there's been a fairly seismic shift in terms of those FOMC collective dot plots going forward, and also into 2017, 2018. And the key thing to remember as well is this is assuming that the US economy still continues to grind a gradual improvement in economic performance. If there's some kind of shock that moves that path away, you may not even get these hikes coming through again. So I think it's a fairly major shift in terms of what we've seen. And it wasn't really indicated in the FOMC statement, because if you read through that, there was hardly any change. There was a bit of acknowledgement that the recent jobs data in both April and May had been substantially below previous months' kind of consensus non-farm payroll figures were around about 200,000. But on the flip side, they were saying, well, economic growth continues to improve. But the major factor from the FOMC statement was that Esther George, the Kansas City Fed, who had dissented and had been pushing for a hike in the previous 2 meetings, actually did fall in line with the consensus and was now happy to not have a hike in this meeting. And in terms of what you saw in the markets, there was a pretty seismic move again in the US Treasury markets across the curve from 2 years out to 30 years. The 2-year did fall around about 5 basis points to 0.67%, and a similar move in the 10 years down 4 basis points to 1.57%. Now, the record low on Bloomberg going back since it started collecting data probably about 60 or 70 years ago is 1.45%, which was in June 2012. So we're not that far away from a record low in the 10-year US Treasury. And I think that indicates to the market, and particularly the equity markets, which are still, in my view, trading at fairly elevated levels, that growth both domestically in the US and more broadly globally is still going to be pretty tepid, pretty sanguine. And in terms of their growth forecast, they did slightly edge those down to 2% for this year and also 2% for next year, lowering those from 2.1 and 2.2 and 2.1 respectively.
Okay, so the FOMC statement made some obvious changes, but was more cautious on the labor market, upbeat though on consumer spending, more concerned about the state of inflation expectations. Let's just listen to more of what Janet Yellen had to say on those 2 fronts.
As the transitory influences holding down and fade, and as the labor market strengthens further, the committee expects inflation to rise to 2% over the next 2 to 3 years. Our inflation outlook also rests importantly on our judgment that longer-run inflation expectations remain reasonably well anchored. However, we can't take the stability of longer-run inflation expectations for granted. Other indicators of the labor market are still flashing green. Initial claims for unemployment insurance remain low. Perceptions of the labor market remain fine. Data from the JOLTS on job openings continue to reach new highs. So there's a good deal of incoming data that does signal continued progress and strength in the labor market. But as I say, it does bear watching.
So Mark Bayley from FIIG, Janet Yellen there referring to those green flashing lights. Is a July hike still possible if we saw a nice rebound in job growth and firmer inflation expectations over the next 6 weeks?
I mean, I think to kind of quote Janet Yellen when she was asked that exact same question, I think she said it was not impossible. But I think in terms of her conviction behind that statement, it was pretty low, and I think that's what the market is telling you. It's a pretty low chance of a hike in July. This all feels very much like last year, where we came to June and potentially the Fed was going to hike. It didn't, and then moving into September, again, is the Fed going to hike? And again, they found a reason not to hike. And I think, again, we're in that same situation where, as you rightly point out, there are those signs, positive signs in the labour market, which may have cooled a bit at the moment. There has been people have dropped out of the labour force and have stopped looking for work. You are seeing some inflationary pressures slightly building again in the wage growth, in the earnings growth, and also coming through in terms of their inflation forecast, which they did raise for this year to 1.4 from 1.2%. But I think once you put everything in the mix, I think July is going to be a tough ask in terms of a hike, and everybody's going to be more focused on September and potentially even December. I mean, I think there's probably going to be one hike this year maximum from the Fed, because I just don't think the economic data is going to support a move higher.
But I think that you brought up a good point, is that in a way we're right back where we started. It feels like Groundhog Day. We saw those dot plot points, really being revised downward. In other words, it appears that the Fed has capitulated and moved closer to what the markets have been pricing in for a long time now. So is the market leading the Fed, or is it worrying that some of the confidence, I guess, that perhaps market participants would like to have in the Fed is being damaged?
I think the market has always been a lot more conservative and a lot more pessimistic on the future outlook for the U.S. economy, and that has been seen time and time again in terms of where the interest rates, U.S. Treasury curve rate, and the break-even rates on some of the longer inflation-linked bonds, and the five-year break-even spreads. And the market pricing has been a lot more conservative in terms of future hikes in the Fed's rhetoric. Even at the start of the year, when the Fed was talking about 4 hikes in 2016, the market was pricing in pretty much 2, and now when the Fed is still talking about 2, the market is probably pricing close to 1. So I don't really think that anything has changed in terms of that relationship. I think generally we've seen over the course of history that the market is generally better, and the bond market is generally better at terms of predicting and pricing in future hikes in terms of what we're seeing from central banks than the equity market or even the central banks themselves in terms of their guidance.
But I guess the point I'm trying to make is that we still had the Fed chair emphasizing just how uncertain the Fed is in its projections, especially regarding forecasts for future rate hikes and growth. Markets hate uncertainty. So if the Fed isn't confident in their forecasts and expectations, then how can investors feel confident making decisions as well? I mean, markets hate uncertainty. We know that.
That's exactly right. And in terms of uncertainty, there's a couple of big events on the horizon. As Yellen pointed out, we've got the Brexit vote, and then even once we get through that, and if hopefully to just prevent dislocation in the market, we have the UK voting to stay inside the EU. We have the Spanish elections on the Saturday on the 26th of June. Again, another major event that could potentially have ramifications for Europe and the more broader market. So you're right in terms of that uncertainty. I don't think that's going to stay away, and I think that's how investors should position their portfolios. It's they should be relatively defensive. I don't see a lot of growth coming through, and still some of those equity valuations, if you want to look at some of the multiples that are out there in the US and more broadly in the global equity markets, are still pretty high, and still expecting to see fairly significant growth coming through to justify those
Mark,
multiples.
You know, sorry, just because we're running out of time, when you mean defensive, I mean, do you think that we're going to see more people pulling money out of the markets and putting it into just cash and holding cash?
I think so. I mean, the SocGen had an article out overnight where it's talking about this great rotation that was meant to happen out of bonds into equities isn't happening. In actual fact, you're probably seeing, and they're pushing for people to move out of equities into bonds, even with the bond yields where they are at current levels. I mean, we've seen some fairly phenomenal negative rates around the world in terms of bond yields, and that indicates where the investor demand is, even at those low levels, and it indicates a general consensus view on economic growth, which should play into the equity markets, but in my view still hasn't. I think equity markets have got further to fall.
Yeah, and we had the ECB vice president saying that negative interest rates in the euro area are very far away from levels that could trigger cash hoarding amongst the population. Do you agree with that?
I think so, but having said that, there's been various comments from German banks saying, look, we're not going to probably deposit our excess cash with the ECB. We're just going to hold it in vaults, and so at least they're getting zero rather than a negative trend by putting it with the central banks.
Uncharted territory. Okay, we'll talk more later. Thanks, Mark. Appreciate it.
Thanks indeed. Have a good one.
Mark Bayley there joining us from FIIG in Sydney. When we return, we'll obviously keep talking about central banks, but we've also got that jobs read coming up today. We'll find out what we can expect from the Australian dollar next.
The new Kia Cerato comes with Australia's only 7-year warranty and a stunning new design inside and out across the range. It starts with the Cerato S from just $19,990 drive away with free auto.